So we have successfully completed the special order analysis. So let's watch our relevant cost for decision makings. So it's not more than 10 minutes. It further clarify your questions and your ambiguities. So let's watch this video.
In addition to decisions regarding their regular product mix, companies are often faced with special orders. For Flowserve, the first relevant cost in considering a special order has to do with opportunity cost. That is, will other products get bumped in order to fill it?
If you have a plant and that is not running at full capacity, obviously you're going to look at taking a new product, a special order from a customer, taking any kind of business a little differently than you might when things are humming along and you're pretty much utilizing your capacity.
Given that the capacity is available, Flowserve then looks at the relevant out-of-pocket costs. The fixed costs of the factory are not a major factor in the decision, as they would be there whether they accept the special order or not. The relevant costs are the incremental costs, or those costs that would be additional if the business were accepted.
So there you tend to make sure you're covering your variable costs. What we would look at very much from variable cost standpoint, the material that you can calculate. That's a very pure example of variable cost. We tend to also look at direct labor as a variable, because oftentimes what we would look at if you could eliminate the cost on a short-term basis, month to month and a quarter, direct labor you can, particularly in the United States. You might look at it a little differently in Europe, where labor tends to be much more fixed.
The basic strategy for many business decisions is to isolate the incremental costs and determine whether the anticipated revenues will exceed them. But determining the actual costs involved in manufacturing can be challenging, particularly when it comes to allocated overhead costs.
But in our industry particularly, we do a lot of special projects. And sometimes those special projects have a lot of costs that can just go into overhead, and you don't realize unless you try to search those out and allocate those directly to a project. You may think you're making a lot of money on a project, and when you've gone through and really done the analysis and allocated the costs, you may have lost money on that project. For example, if a project's particularly complex, it may have a lot of special material purchasing requirements or a lot of special engineering design time that may need to go into that. And if you don't allocate those costs directly to the project or the product, you're really missing out a big portion of the cost.
There may be many different costs that seem to be associated with a decision. But the only ones that matter are those that will change in the future based on the alternative chosen. The same is true for revenues. Isolating the relevant costs and revenues simplifies the decision-making process and provides the clearest look at the financial consequences of each choice.
Just about any decision that potentially affects profits in some way in a profit-making organization, you have to identify what's relevant and what is not relevant in terms of the future revenues and the future costs.
Identifying and isolating avoidable costs is the critical first step in making a sound business decision. Complete analysis of a decision-making situation requires close examination of the relevant numbers.
Let's consider a decision of whether you're going to make some product or service yourself or buy it from the outside. Now, this is a major decision. It can affect in big ways a company. It might lead to closing down a plant or a facility, for example, if you decide to buy something rather than make it yourself.
At Flowserve, the decision to outsource a product or process is often a seasonal one, depending on the level of demand.
We, from time to time, do make various outsourcing decisions, and sometimes we make that decision because we don't want to add additional capacity ourselves. We have a bottleneck or a constraint, and so not wanting to make additional capital investment and to get us through a period where we may have unusual demand, we will outsource machining or something like that for a period of time. We probably try to look at a number of different things to make an outsourcing decision. First of all, what what the cost is internally versus externally.
Relevant costs and revenues should be isolated in a written differential cost analysis. Let's say that the total costs of machining a part internally include direct materials, direct labor, equipment depreciation, and allocated fixed and variable overhead. There may also be an opportunity cost to consider when the plant is at full capacity. However, some of these costs can be eliminated from consideration. The depreciation on equipment is a sunk cost and thus is not relevant. The fixed overhead allocation will likely continue unchanged in either case, so it can be taken out as well. Assuming no opportunity costs, the costs add up to a total of $60,000. Next, we list the total costs for outsourcing the machining. The primary direct cost is the $72,000 price paid to the outside supplier. The analysis favors making the part for a $12,000 savings. As a general rule, if the incremental costs of outsourcing are less than handling the product or process internally, then a business may want to consider going outside. However, saving labor costs through outsourcing may be more illusory than real, especially when the outsourced labor is located halfway around the world.
There have been examples where you look at low-cost labor plants that we may have around the globe. And one of the mistakes that often is made is that people so focus in, oh, we have much lower labor costs, and it may represent under 10% of the total cost of the business. Well, all the structural costs remain in the high-cost country, whether it be in the United States or Europe. So your real savings, when you consolidate your businesses, is much less, oftentimes, or non-existent, because you haven't identified those costs that aren't going away and have chased a very small portion of your costs. You may actually have fooled yourself into taking an action that increased the cost of your total business as opposed to those variable portions.
In addition to cost considerations, the make or buy decision also carries a significant strategic aspect.
When we do look at outsourcing, there are a couple things we do think about. First of all, is it a core competency or something that's special to the company that we do that maybe someone else can't do, or we don't want to transfer that technology to someone else. And so that's a very key part of the decision.
If you decide not to make a product, you're probably going to be laying off people. This is going to have an adverse effect probably on the morale of remaining employees. They're going to wonder, are you going to be shutting down future production of other products?
The make or buy decision is a critical one for any manufacturer with important financial and strategic ramifications. Equally complex is the decision relating to whether a particular product line should be dropped or added.
When we're looking at either keeping or divesting a product line, what we look at is that we go back to the strategic plan and we say, okay, is this product line that we're looking at strategic to the organization? Once we look at it from a strategic standpoint, then we get down to the nuts and bolts, and we'll go through and try to figure out why it's not achieving the growth and the profitability that we thought it would. And if it turns out to be an issue that we can fix, whether it's replacing current management or buying more or different capital equipment, we will then look at, whether or not we have the time, the ability, the inclination, or the right technology actually to turn this operation around. If we decide that we don't, then we'll look at divesting it.
The variable costs associated with a product line are generally avoidable if that line is discontinued, but fixed costs may not be avoidable. Fixed costs for a product line may include salaries, advertising, utilities, depreciation, rent, insurance, and general administrative expenses. Some of these costs are allocated portions of the company's overhead expenses, and thus are not avoidable. Depreciation is always a sunk cost, and also not avoidable. The avoidable costs are totaled and compared to the product's contribution margin. In our example, the contribution margin that the product is adding to the company is more than the fixed costs that could be avoided if it were dropped. So based on this data alone, the product should be retained.
Basically, you look at the revenues of that product versus the variable cost, and that gives you your contribution margin, and you say, okay, how does that stack up to other operations that we may have? How does that go towards contributing to covering the fixed costs that we have for that operation? So even though you may have a product line that looks like it's losing money from the gross margin standpoint, it may have a very positive contribution margin, and if you were to divest that product line, the fixed cost would still be there, but you would no longer have the contribution margin to help cover that cost.
Other factors may also come into play. With technology constantly changing, a product that is profitable now could be obsolete in the near future. Thus, a company must also try to predict the opportunity costs of sticking with a product that is on its way out.
And a lot of the operations that we look at are profitable operations. It's not as if they're losing money, it's just that fundamentally where they're making money now, the technology is going in such a direction that we don't think in the long term that they're going to be viable.
Major business decisions require a careful examination of the quantitative factors, such as cost and revenues, as well as other qualitative factors. The complex financial analysis can be simplified by isolating the relevant costs and taking care to avoid a few common pitfalls.
One thing you ought to note is that oftentimes companies don't do a very good job of identifying the relevant costs in these kinds of situations. And what they do is they tend to include in the cost of making the product themselves all or virtually all of the relevant costs, and they also throw in a lot of costs that are not relevant in this decision that would not go away even if you eliminated the product entirely. They just simply make a mistake in logic when they do the analysis. So from the standpoint of the hard data, they often are working with the wrong numbers, and it leads them to outsource and to shut down production when they really shouldn't.
Okay, so I would be adding the assignment 5 in our WeChat group and Blackboard as well. So kindly respect our due date. The due date going to be announced on the either of the platforms. So try to solve it ASAP. We are also going to hold our Zoom live discussion, and the time and the day going to be decided, and I'm going to upload the timing also along with the assignment 5 on a group. Well, thank you. This is the end of the lecture. Thank you for being patient with me, and thank you for listening to me. If you have any question, please do write us in our WeChat group, in our Blackboard discussion forum. I'm going to be uploading our book chapter, PPTs, and assignment in our both discussion or our forum like WeChat and Blackboard. So see you next time on our next exciting lecture series on managerial accounting. See you. Bye bye. Stay safe. Stay healthy.